The stock market has always been presented as the ultimate path to wealth creation in America, a place where anyone with a few dollars and a dream can participate in the growth of the economy and watch their money multiply over time. Yet the reality tells a vastly different story, one where the overwhelming majority of Americans who venture into the world of stocks find themselves losing money rather than making it. And understanding why this happens requires us to look beyond the simple explanations and dive into the structural, psychological, and economic forces that shape this outcome. When we talk about 99% of Americans losing money in the stock market, we are not merely speaking in hyperbole, but pointing to a documented pattern that researchers, economists, and market analysts have observed for decades, where the average retail investor consistently underperforms not just professional investors, but even the market itself. And this phenomenon persists regardless of economic conditions, technological advances, or the democratization of trading platforms that promise to level the playing field. The first and perhaps most fundamental reason for this lies in the very nature of how most people approach the stock market, treating it not as a long-term investment vehicle designed to compound wealth slowly over decades, but as a casino where quick profits can be extracted through clever timing and strategic moves. And this mentality is reinforced by a culture that celebrates overnight success stories while ignoring the countless failures that never make headlines, creating a survivorship bias where everyone hears about the person who made millions on Tesla or Bitcoin, but nobody talks about the thousands who lost their savings chasing similar dreams. Market timing, the practice of trying to buy low and sell high by predicting short-term movements in stock prices, is the single most destructive behavior that retail investors engage in, because while it sounds perfectly logical in theory, in practice it requires an almost superhuman ability to predict the future, something that even the most sophisticated hedge fund managers with armies of analysts and cutting-edge algorithms struggle to do consistently. Yet ordinary Americans armed with nothing more than news headlines and gut feelings believe they can somehow crack this code. Studies examining investor behavior over 30-year periods have shown that while the market itself delivered returns of around 10% annually, the average investor earned less than half that amount. Not because the opportunities were not there, but because they kept jumping in and out at precisely the wrong moments. Buying when euphoria pushed prices to unsustainable heights, and selling in panic when corrections brought prices down to bargain levels. And this behavior gap, as researchers call it, represents the single largest destroyer of wealth in the investing world, far exceeding the impact of fees, taxes, or any other factor. This pattern repeats itself with such regularity that it has become a fundamental truth of market behavior, observable during the dot-com bubble of the late 1990s, when millions of Americans poured their savings into technology stocks they did not understand simply because prices were rising, with people quitting their jobs to become day traders, taking out home equity loans to invest in companies that had never made a profit and had no clear path to profitability, only to watch those same stocks collapse by 80 or 90%, when reality set in and the realization hit that websites with no revenue model were not actually worth billions of dollars, leaving behind a generation of investors who lost not just their capital but years of their financial lives. The same dynamic played out again during the housing crisis of 2008, when people who had never invested before suddenly found themselves drawn to financial stocks that seemed like bargains, reasoning that institutions like Bear Stearns or Lehman Brothers had been around for decades and would surely recover from their temporary difficulties, unaware that many of those institutions were on the verge of complete collapse because they had made leveraged bets on mortgage securities that were essentially worthless. And the people who bought into this narrative lost everything when those firms either disappeared entirely or saw their stock prices fall by 99%. The psychological dimension of this problem cannot be overstated because human beings are simply not wired to make rational decisions when it comes to money, especially when emotions like fear and greed are involved. And the stock market is specifically designed to trigger these emotions at maximum intensity, creating a feedback loop where rising prices generate excitement that pulls more people in, while falling prices create panic that forces them out. And this emotional roller coaster is exhausting and expensive because every emotional decision typically involves buying or selling at precisely the wrong time. Ego plays a central role in this dynamic because most people genuinely believe they are smarter than the average investor, that they possess some unique insight or analytical ability that will allow them to succeed where others have failed. And this overconfidence is constantly reinforced by financial media that presents investing as a skill that can be mastered through research and discipline rather than what it actually is, which is a complex probabilistic game where even the best players lose regularly and where the house, in the form of fees, commissions, and structural advantages held by institutions, always takes its cut. And this misconception is particularly dangerous because it prevents people from recognizing their own limitations and seeking strategies that would actually work for them. The illusion of control is another powerful psychological trap, because when someone buys a stock and watches it go up, they attribute that success to their own brilliance and analytical prowess, convincing themselves that their careful research and strategic thinking led to the profitable outcome. But when that same stock goes down, they blame external factors like market manipulation, bad luck, or unforeseen events. And this cognitive bias prevents them from learning from their mistakes or recognizing the fundamental truth that short-term price movements are essentially random noise that no amount of analysis can consistently predict. Which means that most of the time when someone makes money on a short-term trade, it is simply because they got lucky, not because they did anything particularly clever. Social proof compounds these problems because human beings are deeply social creatures who look to others for validation of their choices, and in the context of investing, this means that when everyone around you is making money in the market, it becomes psychologically painful to sit on the sidelines, even if you know rationally that prices have become detached from reality, which is why bubbles always pull in the maximum number of participants right before they burst, ensuring that the people who can least afford to lose money are the ones holding the bag when prices collapse. And you can see this dynamic playing out in real time whenever a particular stock or sector becomes fashionable, with people who normally never talk about investing suddenly becoming experts on whatever the hot topic is, whether that was marijuana stocks, cryptocurrency, electric vehicles, or most recently, artificial intelligence companies. The structural advantages that institutional investors enjoy over retail investors create another layer of disadvantage that most people do not fully appreciate, because these institutions are not just bigger and better funded, but operate under an entirely different set of rules that give them information, execution speed, and market access that ordinary investors can never match. And this is not a conspiracy theory, but simply the reality of how markets function when participants have vastly different resources and capabilities. High-frequency trading firms can execute thousands of trades per second and profit from price discrepancies that exist for mere microseconds, effectively extracting tiny amounts of money from every transaction that passes through the market through a practice called front-running, where they detect large orders coming into the market and position themselves to profit from the price movement those orders will create. And while each individual extraction is small when multiplied across billions of daily trades, it adds up to enormous sums that come directly out of the pockets of slower-moving retail investors who do not even realize they are being systematically disadvantaged every time they click the buy or sell button. Information asymmetry represents another critical structural problem, because by the time ordinary investors hear about a piece of news or a market development, institutional investors have already processed that information and adjusted their positions accordingly, meaning that retail investors are perpetually reacting to yesterday's news while professionals are already positioning themselves for tomorrow. And this gap can never be closed, no matter how many hours someone spends reading financial reports or watching business news, because the institutions have direct access to company management through private meetings and conference calls, proprietary research produced by analysts who spend their entire careers studying specific industries, and sophisticated analytical tools that cost millions of dollars and require teams of specialists to operate. Consider what happens when a company announces earnings results. Institutional investors with direct lines to management teams have often already positioned themselves based on guidance they received weeks earlier through legal but non-public channels, while retail investors are left to interpret the public announcement without any of that context. And by the time they decide to act, the institutions have already moved on to their next trade. The fee structure of the financial industry represents a massive but often invisible drain on returns, because every mutual fund charge, every brokerage commission, every advisory fee, and every expense ratio takes money directly out of an investor's account. And while these fees might seem small in percentage terms, perhaps 1 or 2% annually, when compounded over decades, they can easily consume 20 to 40% of total returns, turning what should have been comfortable retirement savings into barely adequate nest eggs that leave people working longer than they planned or retiring with a significantly reduced standard of living. This fee extraction is made possible by the complexity of financial products that deliberately obscure their true costs, using terms like expense ratios, load fees, and 12b-1 charges that mean nothing to most people but represent very real transfers of wealth from investors to financial intermediaries, and the industry has fought tooth and nail against regulations that would require clear disclosure of these costs, because they know that if people truly understood how much they were paying in total fees over their investing lifetime, they would revolt and demand lower-cost alternatives. The myth of stock-picking ability represents another major source of losses, because the financial industry has spent billions of dollars convincing people that selecting individual stocks is a skill that can be learned, and that with the right advice or research tools, anyone can build a portfolio that beats the market. Yet decades of academic research has conclusively demonstrated that even professional fund managers who do this for a living rarely beat simple index funds over long periods, with studies showing that over a 15-year period, more than 90% of actively managed funds underperform their benchmark index after fees. And when a few do manage to outperform, it is often due to luck rather than skill, as evidenced by the fact that past performance has almost no predictive value for future results, and funds that beat the market 1 year are no more likely to beat it the next year than funds that underperformed. The gamification of trading through modern apps and platforms has dramatically accelerated the rate at which people lose money by making it easier and more psychologically compelling to trade frequently, with features like confetti animations celebrating trades that make buying a stock feel like winning a game, push notifications alerting users to market movements that create artificial urgency, and frictionless interfaces that allow someone to buy or sell stocks with a single swipe. All designed to maximize trading frequency, because these platforms profit from the volume of transactions regardless of whether users make or lose money. And this design is so effective that people now trade stocks while standing in line at the grocery store or sitting in meetings, making consequential financial decisions with less thought than they would give to buying a pair of shoes. The rise of options trading among retail investors represents an even more dangerous development, because options are leveraged instruments that can amplify both gains and losses by factors of 10 or more, turning modest market movements into catastrophic losses for people who do not fully understand the mathematics of how these instruments work. And the explosion of options trading volume among retail investors in recent years, driven by social media hype and the promise of quick riches, has created a generation of traders who are essentially gambling with complex financial derivatives that professional traders spend years learning to use properly, with stories emerging of people losing their entire life savings in a single day because they sold options without understanding that their potential losses were unlimited. Tax inefficiency represents another often overlooked source of losses, because every time an investor sells a stock at a profit, they trigger a taxable event that can consume 20 to 40% of that gain depending on their income level and how long they held the position. And frequent traders can find themselves in situations where they made money on paper during the year, but after accounting for taxes on their gains and the inability to fully deduct their losses, they actually ended up behind, especially if they then continued trading and lost money in subsequent years, creating a situation where they owe taxes on gains they no longer have because subsequent losses ate up their capital. And the IRS does not care that you lost the money after you made it, they still want their cut of the gains. Recency bias causes investors to give disproportionate weight to recent events when making decisions, which means that after a period of strong market performance, people become convinced that the good times will continue indefinitely and increase their risk exposure right before a correction, while after a market crash, they become convinced that stocks are permanently dangerous and move to cash right before the recovery begins, ensuring that they consistently buy high and sell low in a pattern that destroys wealth over time. And you can see this pattern in the data that shows retail investors consistently increase their equity allocations at market peaks and reduce them at market troughs, doing precisely the opposite of what would be profitable. The democratization of information through the internet and social media was supposed to level the playing field by giving retail investors access to the same news and data that professionals use, but instead it has created an overwhelming flood of contradictory information, hot tips, and persuasive narratives that make it harder rather than easier to make sound decisions. Because for every piece of solid analysis, there are 100 hype-driven posts promoting the latest meme stock or cryptocurrency, and distinguishing between legitimate investment thesis and sophisticated marketing becomes nearly impossible for someone without deep expertise. Particularly when influencers with millions of followers are promoting investments without disclosing that they are being paid to do so, or that they plan to sell their own positions as soon as their followers drive the price up. Confirmation bias ensures that once an investor has made a decision to buy a stock, they will unconsciously seek out information that supports that decision while dismissing or ignoring evidence that contradicts it, which means they hold losing positions far longer than they should while convincing themselves that the market simply has not recognized the value they have identified. And this inability to admit mistakes and cut losses is one of the primary ways that small losses turn into catastrophic ones. With investors averaging down on losing positions by buying more shares as the price falls, throwing good money after bad in the belief that eventually they will be proven right, only to watch the stock continue falling until their entire position is worthless. The pressure to generate returns creates a situation where people feel compelled to take action even when the best course would be to do nothing, because sitting in cash or holding a simple diversified portfolio feels passive and boring compared to actively trading and trying to beat the market. And this action bias leads to overtrading, which generates fees and taxes, while exposing investors to unnecessary risks that would be completely avoidable if they simply did nothing. But doing nothing feels psychologically impossible when you're constantly bombarded with messages about opportunities you are missing and gains other people are making. Market crashes and corrections are inevitable features of stock markets that have occurred regularly throughout history, with clockwork regularity. Roughly every 7 to 10 years, the market experiences a decline of 20% or more. Yet somehow, each new generation of investors convinces themselves that this time is different and that they will be smart enough to get out before the crash happens, ignoring the fact that crashes by definition happen suddenly and without clear warning signs, and that the vast majority of people do not realize a crash is happening until they have already lost a substantial portion of their wealth, because the first day of a crash typically looks like just another down day until several more down days follow, and suddenly everyone realizes the market is in free fall. The narrative that stock investing is essential for building wealth and that anyone who is not in the market is missing out creates enormous social and psychological pressure to participate even when someone's financial situation, risk tolerance, or knowledge level makes it inappropriate for them to do so. And this pressure is deliberately cultivated by a financial industry that profits from having as many people as possible actively trading and paying fees, regardless of whether those people are actually building wealth or destroying it, with entire marketing campaigns built around the fear of missing out and the shame of not participating in the American dream of wealth creation through stock ownership. The complexity of modern markets, with their derivatives, leverage, high-frequency trading, algorithmic systems, and global interconnections, means that even experienced professionals often do not fully understand the systems they are operating within. And when something unexpected happens, whether it is a pandemic that shuts down the global economy, a geopolitical crisis that disrupts energy markets, or a technological disruption that renders entire industries obsolete overnight, these complex systems can produce cascading failures that wipe out positions faster than anyone can react, leaving retail investors who thought they were making conservative investments suddenly facing losses they never imagined possible because the risks were hidden in layers of complexity that nobody explained to them. The fundamental disconnect between the stock market and the real economy has grown increasingly pronounced over recent decades, with stock prices often rising even as ordinary Americans struggle with stagnant wages, rising costs of housing and healthcare, and economic insecurity about their future, because the stock market primarily reflects the interests and fortunes of large corporations and wealthy investors, rather than the economic well-being of average citizens, which means that someone can correctly understand that the economy is in trouble for most people, but still lose money by betting against a market that is being propped up by central bank policies that pump trillions of dollars into the financial system and corporate buyback programs where companies use their profits to purchase their own shares and artificially inflate the stock price rather than investing in their businesses or paying workers more. The zero-sum nature of short-term trading means that for every winner there must be a loser, and in a game where institutional investors with superior resources, information, technology, and legal teams are competing against retail investors with none of those advantages, it becomes mathematically certain that wealth will flow from the many to the few, not because the system is explicitly rigged in the sense of being illegal, but because it is structured in a way that inevitably produces this outcome. Just as a casino is structured to ensure that over time money flows from gamblers to the house even though any individual gambler might win on any particular day. The leverage trap catches many inexperienced investors who discover that they can control larger positions by borrowing money from their broker through margin accounts. And while this leverage can amplify gains when trades go well, it also amplifies losses and can result in margin calls where the broker demands immediate payment or forcibly sells positions at the worst possible time. And many people have lost far more than their initial investment because they borrowed money to invest and then watched helplessly as both their own capital and the borrowed funds evaporated, leaving them deeply in debt with nothing to show for it. Anchoring bias causes investors to fixate on the price at which they bought a stock and use that as their reference point for all future decisions. So if someone buys a stock at $50 and it drops to $30, they convince themselves they will hold until it gets back to $50 so they can break even. But that $50 price point has no significance whatsoever to the market or to the fundamental value of the company. Yet investors will hold losing positions for years waiting for them to return to the arbitrary price they paid, foregoing opportunities to deploy that capital more productively elsewhere. The disposition effect describes the tendency for investors to sell winning positions too early to lock in gains and feel good about being right, while holding losing positions too long because selling would require admitting they made a mistake. And this pattern is exactly backwards from what would be profitable because it means investors end up with portfolios full of losing stocks that they are emotionally attached to while selling off their winners before they have had a chance to compound. And studies have shown this effect is so powerful that it persists even when investors are explicitly taught about it and warned to avoid it. Herd mentality drives massive flows of capital into whatever asset class or sector has performed well recently, with investors assuming that recent performance predicts future performance, even though the opposite is typically true. And this creates momentum bubbles where prices become completely detached from fundamental values as more and more people pile in simply because the price is going up. And these bubbles always end the same way, with a sudden reversal that catches the maximum number of people at the peak holding overvalued assets that then crater in value. The illusion of knowledge leads people to believe that because they can easily access information about companies and markets, they therefore understand those companies and markets. But information is not the same as understanding, and most retail investors lack the framework to interpret the information they access in meaningful ways, leading to confident decisions based on fundamental misunderstandings of how businesses work or what drives stock prices. Home bias causes investors to overweight their portfolios toward domestic stocks and the specific region where they live because those companies feel familiar and safe, but this creates unnecessary concentration risk and forgoes the diversification benefits that come from global investing. And many Americans learned this lesson painfully when domestic markets crashed, while international markets held up better or vice versa. The sunk cost fallacy traps investors into continuing to put money into losing investments because they have already invested so much that walking away feels like admitting defeat, so they throw more money at bad investments in an attempt to rescue their earlier mistakes, not realizing that past investments are gone regardless and future decisions should be based solely on future prospects, not past commitments. Ultimately, the reason 99% of Americans lose money in the stock market is not because they are stupid or lazy, but because they are participating in a system that is fundamentally designed to extract wealth from unsophisticated participants and transfer it to sophisticated ones through 1,000 different mechanisms that work together to create an environment where winning is extremely difficult for anyone without significant advantages. A system where the house always wins not through any single mechanism, but through the cumulative effect of psychological biases that cause predictable errors, structural advantages that give professionals better information and execution, fees and taxes that drain returns before they can compound, and the simple mathematical reality that trying to beat the market is a negative-sum game after costs, because for everyone who beats the market by X%, someone else must underperform by that same amount. And since professionals control most of the money and have most of the advantages, it is retail investors who end up on the losing side of that equation the vast majority of the time. The truly rational response for most people would be to minimize their exposure to these forces by investing in simple, low-cost index funds that track the entire market and holding them for decades without looking at the balance, adding money consistently regardless of whether prices are high or low, and letting compound interest do its work over time. But the very psychology that makes this approach optimal also makes it incredibly difficult to follow because it requires accepting that you cannot beat the market, that you are not special, that boring, consistent accumulation over time is the only reliable path to building wealth through stocks, and that you will have to sit through stomach-churning declines of 30 or 40 or 50% without panicking and selling. A message that no one wants to hear in a culture that celebrates bold risk-taking, exceptional individual achievement, and the fantasy that with enough effort and intelligence, anyone can outsmart the system and achieve extraordinary returns. The financial industry will never tell you this simple truth, because there is no money in it for them. They cannot charge high fees for managing an index fund that requires no management. They cannot generate commissions from clients who buy and hold forever. They cannot justify their existence if people realize that the best investment strategy is one that requires no experts and no advice and no trading and no sophisticated products. Just regular contributions to a diversified portfolio held for the long term. And so they continue to perpetuate the myth that investing is complicated and requires professional help, and that with their guidance you can achieve better results than the market average, even though their own results prove year after year that this is not true, and millions of Americans continue to participate in this system, handing over their hard-earned money to be churned through the machinery of fees and bad decisions and psychological traps and structural disadvantages, believing that somehow their outcome will be different from the 99% who came before them, not realizing that this belief itself is part of the trap that ensures they will join that 99%, rather than escaping it.